Hey everybody, I'm Mike Desepoli and welcome to the Heritage Market Minute for Monday, August 9th. We hope you enjoyed your weekend. Recapping at the end of last week, we had the jobs report coming out on Friday. Jobs growth was above expectation for the month, adding about 950,000 jobs, which came in about 100,000 above expectations. So obviously a good thing anytime we see job growth in excess of analyst estimates. One thing that bears a little bit watching in some of the figures is there was a lot of that job growth, about 1/3 of it came in government jobs. So it remains to be seen, are these permanent jobs or are these part-time seasonal type jobs that may make the numbers look good but might not have the long-term impact that we hope. We will get more updated numbers at this Thursday morning with the weekly jobless claims like we do each and every Thursday morning. So that'll bear some watching, but nonetheless, we always like to see people going back to work and job gains coming in above expectations. We're starting to slow down a little bit in terms of the earnings calendar. We've gotten through the largest batch of companies. There is still some remaining this week, but the largest market components, most of them have already reported. It's been a very largely positive earnings season. We've seen beat rates, that is the rate of companies reporting numbers above expectations, about 82% this earnings season, so that is very strong. And we think that validates this market continuing to improve. The month of August tends to seasonally, if we look back at history, be a little bit of a weak month. That doesn't mean it's cause for concern or the reason to exit the market, but just something that bears watching. August tends to have a lot more volatility because trading volumes are lighter. Why are trading volumes lighter? Likely because people have things in the summer months, particularly in August, that they are more concerned with than the market. Looking at the economic calendar this week, we will see the Small Business Optimism Index report tomorrow. That's a good gauge to get an idea about how small business owners are feeling about the prospects of their business looking forward. And as well as, like I said, we will get non-farm productivity and job openings data on Thursday morning this week. We're continuing to see oil bounce in price, which tells us that consumption is obviously continuing to pick up. So that's something that we believe ties along with economic reopening. And even though we still have COVID concerns about variants and what that might do to economic growth and the recovery, the market so far has taken it in stride. As far as things we'll be watching this week, we continue to monitor interest rates, right? The market's barometer for interest rates is the 10-year yield, and that usually gives a very good clue as far as where does the market think interest rates will go. Remember, we've spoken about this a lot. We don't want to see interest rates go too high too quickly or too low too quickly. We like them moderating in the range where they are now because it provides a good backdrop for the stock market. We don't think that the employment report on Friday was too strong that it's going to force the Federal Reserve to raise rates ahead of schedule. But we will be hearing from one of the Fed chairpersons this week. That's Loretta Mester speaking about inflation at a conference on Wednesday. So always interesting to hear what they think. Obviously, they're all independent thinkers, and even though the Fed acts in unison, it can give us some clues as far as the direction of monetary policy by listening to some of the individual participants. So that's all we have here today. We did not get out a Heritage Market Pulse this past Friday. I'd taken some time off to spend with the family, but we will be back this Friday. So keep an eye out for the Market Pulse coming later this week. We hope you have a great Monday. If you have any questions, feel free to reach out to us. Have a great day.